Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending February 23rd, 2024. I'm the host of InvestTalk, Justin Klein, and today I'm going to tell the video. NVDA beat fails to bring a breakout in markets. We're going to talk a bit about that. But let's start off with some economic data and we'll dig into a little more important information than just the weekly and monthly economic data. Obviously, liquidity is most important, and we'll dig into that. But really, there was a very light week for economic news. The most important was the weekly jobless claims, and most importantly, the continuous claims for unemployment that did tick down a little bit. So that was showing a bit of strength in the current labor market, despite the layoffs. Large corporations overall, it is a job market that's hanging in there. Okay. Now, I wanted to highlight this because this is the what are called the RRP balances, reserve repo. Okay, reserve repo, and I don't want to get into the details of it, but basically, what it's showing is when this is rising, that is liquidity being taken out of the market. Now, this happened in a time where interest rates were being shoved to zero. There was massive QE, et cetera. And so this kind of offset that to a degree and gave ammunition for the money coming off of this is basically a Federal Reserve balance sheet asset. And when this goes down, it's dollars going into the economy. And so it's liquidity going into the economy. And now that the Fed continues to do QT, this is basically sterilizing QT since the middle part of 2023 and kind of post the banking crisis. The banking crisis was a clear uh, a clear marker that there was not enough reserves in the system. Okay. And so what this has done is put reserves back into the system, the overall economy, et cetera. Now, when this stops going down, the big question is what will happen with liquidity? Meaning when this goes to zero, what happens with liquidity like it was 2018, 2019, and early 2021? And the simple answer is the Fed is going to have to be ready to stop QT because it's pretty clear that soon after this is exhausted, there is probably going to be some sort of accident the uh, like the banking crisis of last spring. Now, what is it? Could manifest completely differently. It could be something in the commercial real estate market, but obviously something else will break. And we know that the Fed does come in with some sort of measure to prevent that from spiraling out of control, like they did with the BTFP back in last spring, basically bailing out the banks and their duration risk on their balance sheet. Now, the question will be what will happen with the overall banking system and then also asset prices. Right? We know that uh, there was a problem with liquidity and being drawn out of the system during that time, in 2022, 2021, et cetera. And you can see that here. Look at this is one of the reasons why 2022 was such a bad year is because all of this liquidity is being drained from the system, drained out of the system. Now it's being put back into the system, right? And we're going to meet the end of this, the zero line, somewhere in mid-year, May, June, probably before the end of Q2. So I wanted to highlight that because it's very important to watch that to see what the next moves in markets will be beyond just the next week or the next month, talking the next quarter or two. Okay. Now, the Fed, and I think this is probably the main reason the markets are still pricing in multiple rate cuts for this year. Although we're here, right, there's a 0.8% chance there'll be no rate cuts this year, but there is a pretty sizable chance there'll be at least 2, 3, 4, maybe even 5 rate cuts. Okay, you could say the median outcome is somewhere around 3.5 rate cuts. And I think that's the market looking at this RRP and saying, hey, they need to switch something, and maybe they keep rates high and they stop QT, and that is enough to kind of keep liquidity, enough liquidity in the system. But history says it probably won't be, and that means they'll have to either cut rates, maybe institute QE, but I don't think they're going to do QE uh, so quickly after ending QT. Okay, so we'll watch out for that. That'll be a bullet in their chamber that I think that they will go back to at some point, probably when there is a disruption in the Treasury market, which I wanted to I'll get to real quick. Here's the move index. This is the monthly chart. And what you can see, this is actually pretty interesting because we're looking at a monthly chart. Remember, this is the VIX of the Treasury market. And what you see here is that post the inflationary scare, post the massive spending in 2020 and 2021, this has stayed elevated, right? Above 100, which are levels really only seen during the COVID crisis here. And during, we had the repo issue that was in late 2019, right? Right here, did perk up to close to 100, not quite there. But what you can see here is that still trending higher, which says there are underlying problems in the Treasury market that are just waiting to erupt. Now, that could erupt 3-4 years from now, and a lot could happen positively from then. And even that event could be positive for asset markets, depending on the uh, Treasury and the Fed's reaction to it. But it's definitely something that is consolidating for a move higher. Now, so far, everything is okay, right? But as long as we stay in this, call it 95 to 130 range, that is just consolidation for a potential move higher. Okay, above 130, that's threatening a breakout. Above 150, it's definitely a breakout, right? Below 95, then you say, okay, things are calming down, and there's situations that are resolving. This is a situation that's resolving itself. Hard to see, but certainly you have to be open to that possibility. Okay. So I wanted to highlight that. I also want to highlight, let's go to NVIDIA, just because that was the big story of the week that did rally on this news, but kind of paused on, sorry about that, that paused on Friday, and on high volume. Now we'll see if we get a reversal, but the sentiment here is obviously at an extreme. You also have a bit of a MACD divergence here that's saying, okay, this is not a strong new high. And then if you move over to the NASDAQ didn't really break out. In fact, it was down yesterday, 44 points. And if you zoom back out to a weekly chart, what you can see is we're still not above the highs from 2021. And then if you go to a growth to value ratio, what you can see here is, we've talked about this before, this is when value started to outperform. This has been the growth, we think, counter trend rally. Still, it's in a downtrend, right? Until we get above this, call it 155 in this ratio, then value still has the upper hand, especially in a rising rate environment or a higher interest rate environment. And what's interesting here is with such bullish reaction from NVIDIA, you didn't get a breakout in the growth side. In fact, you got a lower high and a pretty strong reversal candle on Friday. And then if you look at some of the more speculative names, SMCI is a good example, right? This big reversal, this is a bearish engulfing. And oftentimes you get a retest of that before a failure. And I think that's what you see here. Obviously a scary one to short, but this technical setup is pretty juicy. Just say that. You also have that MACD divergence there as well. I didn't get to this on the NASDAQ as well. Go to a weekly. Look at this MACD divergence. Sorry, on a monthly. There we go. That's what I was looking at. Look at this MACD divergence. So, still this could break out, but what's interesting is a fever pitch of positivity around AI and NVIDIA, etc. And this does not look like it has much more momentum to the upside. So I wanted to highlight that because it was a very important event this week, or talked about event, and I think it was interpreted one way, but I actually interpreted a different way. The dollar also not getting much traction to the upside. That was pretty interesting, despite the 10-year moving higher throughout the for most of the week. But this is not gaining much traction to the upside. This is what we call a bear flag. Okay, move down, slow, weak, move up, and likely headed lower. You can see this Williams percent R is over bought, as well as look at this MACD. It's threatening the zero line, and that would mean a downtrend in rates, at least in the near term. Now, I'm still expecting, sorry, in the medium term, I'm still expecting a more choppy environment, but what is the signal that the market is sending you? Let's see, what else do I want to get to? I think that's most of it. Uh, Oil is getting some traction to the upside. You can see that here, starting to make a series of higher highs, higher lows. It's a choppy one. It's not a strong one, but certainly of note. The XLE now above all the major moving averages. That is getting some traction to the upside. And same with industrials, right? Industrials hitting high. And that is kind of what you're seeing is this. I think it's important. I want to go back to this because it's important for people to understand that this trend was starting to reemerge in the fall, and due to what I believe it was earnings season, speculation on earnings season around NVDA and a lot of these tech names. The option activity in these names was at a fever pitch in January and February, and now we're past those two OPEX months, and it's going to take more ammunition for them to put money towards a gamma squeeze in those names. And that's basically what you've seen with NVIDIA and a lot of the AI names. While underneath the surface, if you look at the Teslas of the world, right, that's been relatively weak. Apple obviously has been relatively weak as well. Google, right, making a series of lower highs and lower lows since earnings. Amazon had a good earnings announcement, and that's probably been the strongest, but still well below its high from 2021, right? So that's not looking great. Meta is probably the strongest as of late, and that's probably a lot of shorts covering from when they went big into the metaverse, and I think a lot of people shorted on that news, and I think this was probably a capitulation the other way. So I wanted to highlight that kind of what I'm seeing in the markets. I do think we're very close to an inflection point, like we saw in the fall of last year. But you're going to need to see the dollar probably weaken. And continued strength in the value side of the market, which I do think will strengthen as we go throughout the year, despite the outperformance so far this year. And I think that's it. That's all I wanted to get to on this Saturday. I appreciate you all tuning in, liking, and subscribing to this channel, as well as our podcast, Invest Talk. I want to remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.